The first type of intervention is mandating service provision and credit allocation. For instance, many governments require banks to set up branches in underserved areas and to provide financial services to the poor. Governments may also require a certain amount of lending to go to selected groups. These kinds of direct interventions are controversial. While these policies can increase access for poor households, they also impose costs on banks that affect their profitability and ability to lend to other sectors of the economy. These policies can also lead to excessive risk-taking and endanger financial stability. Governments also intervene by subsidizing credit to the poor. While these subsidies can be helpful to the poor, it is important to consider whether spending on other needs could offer even greater benefits. For example, the government could instead spend the money on education, healthcare, or food for the poor. This cost-benefit exercise is important, but is usually not done. In general, subsidies to the financial sector may be harmful if they reduce the incentive for the financial sector to innovate. However, certain targeted subsidies may be helpful. For example, financial institutions may underinvest in certain areas, such as developing a new payment system, since they do not fully account for the benefits that go to other users. In such cases, government subsidies can improve investment. Finally, governments also intervene by imposing interest rate caps and debt forgiveness. While interest rate caps are intended to limit exploitation, they can lead to reduced lending to high-risk groups and to those who want small loans. Lenders also raise fees to compensate for the lower interest rate. Loan forgiveness programs are intended to relieve over-indebtedness. However, these can increase moral hazard on the part of borrowers and discourage further lending.